Now, with rising interest rates, stocks are dropping. And it's really hard to watch them drop, but there could be an opportunity. And that's why I've been buying these 2 Canadian dividend stocks over the past month. Because buying high quality assets when there's a drop in the market, well, they're the fastest to recover when the market correction ends. One of these stocks has a whopping 125% over the past 5 years. And the other stock has taken a 20% haircut, but its dividend yield is over 7.5%. And buying great dividend stocks that are taking a haircut and investing them in the long run in your tax advantage accounts like your RRSP, your TFSA can really boost your returns over the long run. Now, the first one is SmartCentres. It is one of the largest real estate investment trusts in Canada that owns 188 locations all across Canada. Now, a real estate investment trust is simply a company that owns real estate without you lifting a finger. So you can own a basket of real estate by owning these REITs. SmartCentres owns a mix of commercial properties and residential properties, and its anchor client is Walmart.
Now you're probably wondering, okay, with rising interest rates, wouldn't it be sketchy to invest in real estate right now because the mortgage payments are going to be a lot higher and its dividend yield is already so high? Maybe it's a dividend trap.
Now that's a great question. Naturally, with rising interest rates, mortgage payments are higher, which is taking a hit in all of our pockets. Well, the same could happen with SmartCentres. But I did a little bit of digging. I saw a lot of their mortgages coming up for renewal are still in fixed rate mortgages, and they are not renewing until 2024 or later. So I think with the rising interest rates, definitely there is risk, but they are super well capitalized and they survived the financial crisis and the 2020 COVID when the economy was shut down and basically a lot of people weren't going to shopping malls. So if they can weather those catastrophic moments, I think they're recession proof. Now, when I look at its financials, its net operating income, which is simply its rental cash flow minus all expenses and not considering mortgage payments, is increasing over time, which means that they are able to increase rent over time, which is amazing. That means when you buy commercial property and you're able to increase rent, the market value of those properties go up over time. Now, SmartCentres is one of those rare REITs that has never cut their distributions. Not even during the financial crisis, not even during when the economy was shut down in 2020. One of the 2 most stressful periods in the stock market in the past 20 years. And another metric that I like to see that's improving, which is adjusted funds from its operations, which is financial jargon just to say how much of its income is it distributing to shareholders. Now, by nature, REITs have to pay a minimum of 90% of their profits back to investors. So as much as we love to have 100% of their profits paid to all of us every single month, unfortunately, it's not sustainable for a company. So what I look for is payout ratio improving over time so that they can weather bad storms. And you can see over the past 3 months, its payout ratio has dropped from 96% to a target of 93%, which gives me comfort and confidence in this REIT. Now, SmartCentres has 98% of its properties occupied and it collects over 99% in rent, which is amazing. And compared to last year, when you look at its net operating income, which is simply its rental cash flow minus all expenses except its mortgage interest, has gone up 4.3%, which means it's able to increase their rent over time despite rising interest rates. Lastly, I love it when a CEO puts more of his money into the company. He's purchased $499,000 worth of stock over the past month. So that gives me confidence in SmartCentres. SmartCentres has been doing a very strategic move of building communities around its commercial properties. And with rising population growth, with higher immigration rates in Canada, well, everyone needs a place to shop and live. Now, the next stock is Hydro One. It is the largest utility company in all of Ontario. Now, there aren't many stock charts where the stock prices just goes up. Well, Hydro One is one of those rare companies that has just done that over the past 5 years with a whopping 125% return. And the government owns a significant portion of this utility company. Now, what I love about Hydro One is that it's got fixed contracts. So they're able to pass on rising power costs back to people like you and me. So rather than us paying higher utility bills, why not profit from these type of companies? And with electric vehicles preparing to dominate the market by 2030, well, this is one of the key reasons why I'm really focusing on utility companies, because the demand for power is going to just go up. Now, looking at the financials, Hydro One has said that they're targeting 5 to 7% year-over-year increases in earnings per share, which means that obviously revenue is going to go up, and they expect that their profits to go up in line 5 to 7% over the next 5 years. Now, Hydro One has a lot of strong characteristics, but one of the characteristics is not expecting it to shoot to the moon about 125% over the next 5 years. But what I do like is that it has stable earnings, steady dividend growth, steady dividends, and smart investments over the next 5 years. I have a very strong outlook on Hydro One because of decarbonization, because of the electric vehicle trend, because of its investments in renewable energy, which mean there's continual growth in the near future. And combined with a strong payout ratio, I'm expecting my dividends to grow for the foreseeable future. Hey everyone, if you're looking at Enbridge stock and wondering if its 7% yield is actually safe, check out this video up here. If you're looking for more passive income ideas, check out this video down here. Anyways, I hope to see you in the next video. Bye!